going to take our time this morning to lean in. Our goal today is to help our clients, our friends, and financial leaders really lean into some profound strategic thinking about change and adaptation. We're going to think about the critical decisions that all of you have to weigh around not just your branches, although that's the theme today. Really, we're going to talk about survival in the next 12 to 24 months. What does it mean not just to get through this, but to come out on top, economically and financially, with the communities around you and the people you serve, with your culture and staff intact as they're making adjustments in their own lives, and with your members and customers behind you. And our hope is we're going to talk also about the importance of elevating your brand in this moment in time. So with that, I would like to dive in.
All right, go ahead.
So let's begin looking at rethinking the future of branch spending in a post-COVID world. What we wanted to do is really go back and remember that moment in time at the later part of 2019, where we were seeing a lot of research that the branch was still wildly intact. Branch visits were still real. A lot of research was coming in and it confirmed a lot of what we've seen for quite some time. 1/3 of consumers visit branches between 2 and 4 times or more a month. This is hard to believe for some people in the midst of all the rise of online and mobile technologies, but this is how consumers are sharing their experiences. 1/3 visit about once a month, and 1/3 visit only a few times a year. Only 2% of people in the United States come maybe once a year or don't step foot through the branches. So we knew the branch was still relevant in 2019. We saw other things that almost every consumer used a financial institution that had physical branches. We also knew that consumers are ranking branches near their home and office, together with good online and mobile access, good rates, and product pricing and fees as the most important issues for them when they choose a new financial institution. Almost 2/3 of consumers visit a branch at least 1 to 2 times or more a month. That's a lot of people. And 44% of consumers said they preferred a discussion with a bank associate inside the branch. And so that question of, is the branch relevant? Well, in late 2019, it was clear branches are not only not dead, they still remain a critical piece of how people choose where they bank and the way in which they choose channels to bank. Then something profound happened. Not only did COVID change our lives rapidly and overnight, as we began to respond and communicate and learn what that meant, we started to tell people to stay home. Don't come to the branch. Don't use the branch. We want you as much as possible to stay home and wait out and let's see what's going to occur ahead. Almost overnight, sentiment among consumers changed, the fastest and most radical we've really ever seen. McKinsey did a survey that said the confidence in the country's economic recovery after COVID-19, 14% were pessimistic, 42% unsure, 44% optimistic on March 16th. Within days, a BizRate Insight study said in the next 12 months, people said the national economy will worsen, 72%, 12% said it would stay the same. And I love the glass half full folks, 16% said it's going to improve. Changes intact. In April, we began to see some of the first consumer preferences about how do you plan to change the way you use channels. And we saw some of the first surprises in April from McKinsey. Visits for branch transactions, people said my visits will be up 9%, and yet the preponderance of people said my branch visits will be down 18%. Online banking, up 15%, significant rise, down only 5%. Mobile banking, just like online, up 14%, down only 8%. So we began to see what does it mean, but without clarity of how will that translate ahead. During this time, we continued to see the rise of analytics-based models, artificial intelligence being leveraged by fintech providers, and the simplicity of getting business done grow significantly. Rocket Mortgage influence in driving fast, easy online mortgages, Lending Club, SoFi, unique models really stepping in to fill that void of wanting it to be done fast, simple, quick answers, quick funding. And the second thing we saw was even organizations like Cabbage suddenly shift instantaneously into the small business market and become small business lenders to distribute PPP loans. We expect to see more of that, and consumers certainly open to those channels and capabilities. CEO of Microsoft, Satya Nadella, said in April, we just saw 2 years of digital transformation in 2 months. Absolutely no one could have predicted how fast all of us as consumers, business owners, would have to lean into digital transformation overnight. It's unprecedented. We will never see a wave likely this fast of people embracing digital transformation. The new customer experience shift has been pretty profound. I laugh about this with my kids and family, but I've had $40 in my pocket for the last 3 months, the same two $20 bills I have not taken out of my pocket because I don't want to hand it to somebody and I don't want to get change back in my pocket. The shift to contactless capabilities, whether it's through plastic cards, contactless payment, Apple Pay, online, is explosive. And among our clients, we're seeing it across the board. Double-digit rises for online technologies, mobile banking, and a range of platforms. And the challenge here is these are not all our platforms. And so while we have a place in this ecosystem, we also have providers that are rising rapidly to become the driver of payments and transactions that previously were significantly aligned with our own consumers' banking relationships. So the question in all of this isn't just a branch question, it's how do you avoid being disrupted? How do we make sure you're participating in this process of transformation and finding a way to maintain your competitive position and advance and adapt to the needs of consumers? Well, this is one way we know that your father's Buick is not likely to be a brand of the future. And that is traditional branches, dated experiences, one based on a model of 35 years ago, are going to have to adapt very, very quickly. This isn't just a question of branches. This is a question of experience. We have entered, and we've entered so rapidly, the age of experiences. We've moved so far beyond transactions that we really, even among consumers, are asking, how do I want to do my banking? And what role do branches and even people play in that? This is a question for us, not only of technology or branches, a question of your very brand. How relevant will your brand be in the coming 12 to 24 months? As if all of that wasn't enough, the question will be, what will different consumers choose as the new normal? We're going to spend time exploring that today and talking about this bridge as people are at a crossroads. In the new normal, what am I going to do? How will I use branches? How will I use ATMs? And what's contactless going to look like? And as if that was not enough, we received news on Monday from the official source that we have now identified the recession officially began in February. The interesting thing is this is one of the longest and deepest economic upcycles and bull markets we've seen. It's been sensational, 128 straight months of economic growth. It's been a record period of growth. And a lot of your financial institutions have benefited from that. Positive consumer sense, a sense of spending, buying cars, buying homes, businesses growing, and that is over for some period of time or significantly altered and changed. So the question we're going to wrestle with today is financial institutions, businesses, and consumers are going to be making changes. COVID-19 and the recession are going to impact us for the next 12 to 24 months. The question is, what do we do? And we're going to spend time today. What does that mean for your branch network? And what can you do to take action and not sit back and hope we get back to normal? Ben, I'm going to shift over to you.
Yeah. So as Mark talked about, we want to look at what does that customer journey look like, and it's understanding customers' behaviors because they're changing right now. We've had a significant amount of change on within our customer member base. We also want to look at scenario planning. So scenario for post-COVID. What should we expect in the banking industry post-COVID to plan for? So let's dive in. So consumers are, in looking at consumer demographics across the board, have had a dramatic increase in adaptation for late adapters on digital purchasing and online purchasing and cashless exchanges. These are people that do not enjoy or do not do any online purchasing. They're having to adapt. We're seeing an unprecedented wave of digital services being introduced and consumers using those for cashless purposes, contactless purposes, making sure they're not touching cash. We're also seeing a comfort with video conferencing, where before COVID, you didn't see as many video conferencing, and we're looking at other industries out there, such as even healthcare. And healthcare is now, Medicare has even authorized video visits with your doctor for certain types of check-ins. So you're able to actually video conference with your doctor right now. And so there's a lot of changes currently happening across the board, and customers are now expecting to be able to reach out and digitally schedule something with someone else and not necessarily have to travel, both on a macro scale and a micro scale. So whether you're traveling on an airplane or you're traveling around town, which affects our branch network. So what does that new normal look like? We also have expectations of online and mobile. We've set up online and mobile services. Most financial institutions have, but the expectations of what we can do on those online and mobile platforms has grown. 76% say it's extremely important to upgrade those services. So very extremely important to upgrade those services, while only 7% think it's not that important to upgrade. So this is a very important point, even though you might currently have online and mobile services. You can't just leave them static. It's looking at how can we enhance these existing services that we have. Even switching gears though, on helping our customers, we have to look at internal staff. Are we giving the staff the tools they need to help our existing customers with this technology? And a whopping 75% This is a study that was done, just released in May, so a recent study. 75% said they've made no to minimal progress in upskilling staff on digital skills. So you have the pressure of consumers demanding online products or digital products, and you have the pressure of staff keeping up with those demands too on even a specific digital initiative that has been introduced into the financial institution. So you have pressure all around on preparing for the next wave of what is that expectation of your customer going forward. We're going to talk about growth in a little bit, but I want to spend a little bit of time talking about retention and sustaining your existing customer relationships. We've seen, especially when COVID originally hit, we saw a lot of our clients retrench and look at their existing customers to say, okay, I want to spend our resources on our existing customers and members to make sure we're servicing them well, and putting a pause on growth. In looking at servicing them well, email emerged as the #1 channel to reach those customers. But we've had a lot of clients too look at how do we look at other channels, omni-channels, besides the online banking and traditional. We have a lot of members that are home, they're watching streaming services. Maybe people have catched up with Tiger King. So you have people that have time on their hands, and how do we reach out? How do we help those customers and members at this time of need? So I'm going to switch gears a little bit and talk about scenario planning. So this is a study from Deloitte called Consumer Banking Remade by COVID-19. It outlines 4 distinct banking scenarios based on the recovery. And the recovery is based purely on time. So scenario 1 being the best scenario moving forward on recovery time, and saying the recovery is initially slow, but it picks up in the second half of 2021. So essentially, you have governments that step in, they effectively collaborate, they share resources, there's no second wave of the virus, immunizations come out, economic activity rebounds in late 2020. And based off this, the banking impact is you have a strong policy response, and it prevents structural damage to the banking industry, and it lends to positive growth within 1 to 2 years. Most mid-tier and community banks weather the storm well, and do because they have strong capital reserves and effective government actions are kicked in. Challenger banks and non-charter financial institutions are shaken because they don't necessarily have the liquidity or capital access that you do as a more established financial institution. There's going to be market consolidation. We're going to see that across the board on all these scenarios. It's going to accelerate. And you're going to see further regulation, I think, on around open banking and data sharing, and with more control in the hands of customers. I think that's what Deloitte is coming out with and saying for the passing storm. This is the best case scenario. The good company, which is the second best case scenario, has us recovering beginning of late 2021, and recovery slows in early 2022 and speeds up again in the second half of 2022. The pandemic persists past initial projections, placing a growing burden on global governments who struggle in handling the crisis. Financial institutions can step in and help gain trust and prestige. The shift towards greater corporate responsibility is seen. And if the banking impact for this is there's going to be a demand for non-loan banking services. The demand for non-loan banking services is going to recover slowly, but regulators will loosen regulations to support flow of credit. Credit is going to be very important in keeping the economy going. There may be increased trust in good companies and results in customers willing to share data more broadly. And challenger banks and other niche players benefit from the rising tide of trust and access to data. And again, the M&A activity will from non-traditional players will pick up during this time. Moving to scenario 3 and 4, I'm going to gloss over these. These are the worst case scenarios, where 3 is the East, China, Far East, would nations emerge from the pandemic stronger, while Western nations struggle. And we have economic powers kind of shift during this time. There's a slow recovery for the US, and the US banking policy shifts towards less protectionism and greater convergence with international rules, more open banking. The scenario 4 is what Deloitte has called lone wolves. And this is the worst case out of the 4 scenarios, where really the COVID-19 continues to mutate and we can't wrap our hands around it, can't find a good solution. And we have a global recovery by mid-2020 or 2022, and with divergence rates and recovery across countries. So different countries will be affected differently. The trust in the banking systems and the decline. This is probably the worst case out of all of these. So where does that leave us? That leaves us, well, with the first 2 scenarios, the best case, and the last 2 being dire. It's the financial institutions' responsibility to start planning for all of them. So how do we even start? And really starting on all of these, one of the common threads, because the traditional way of banking won't work, is to look at, for picking branch locations or even talking about branches during this time, is to look at your customer base and specifically understanding your ideal customer, because in all of these scenarios, you have to be targeting and specifically going after the right groups of people going forward. And with that, I'll hand that over to Mark.
Awesome. Thanks, Ben. Well, we think one of the most fundamental pieces of financial institutions really should come down to not just the branch decisions you make and the technology decisions you make. It really should emanate first from who your members and customers are and which ones are going to help you drive growth ahead. Whether that growth is with existing relationships or that growth is new acquisition of prospects, we've got to know a whole lot about who they are and where that's coming from. As we think about different audiences, and as we begin to think about them in the financial industry, we've worked for years and years with a very limited basic set of typically demographics, age, income, a simplistic view. And we've taken much more of a cross-selling operational sales culture approach to viewing them as how do we get them to move from single service relationships to more cross-selling. What we haven't done a great job of is understanding how they think, feel, what their needs and interests are, and what's important to them. And that's changing fast. So the issue for us is that generational channel preferences have been quite surprising. And this is a shock for many people who have made big assumptions that millennials, as they use incredible amounts of mobile and online technologies, don't use branches. Poor assumptions. What we're seeing now for a number of years, as this generation continues to age, is quite surprising, is that millennials versus all generations interact quite similarly. Although their mobile is 50% higher than other generations, their use of branches with the customer service, member service representatives is 15% higher. 15% more millennials use phone with a live agent, want to talk to someone. 9% higher use of ATMs than other generations. And the last one's important, 5% less in-branch use with a teller. They don't view the branch as a transactional point, they view it as a relationship, advice, and problem-solving point. And so that generational differences becomes critical to us as we think about growth ahead. The question we need to understand from, and it only can come from analytics and data, is to understand what those relationships are and their impact on your organization. Which ones of them are most valuable and you should fight to protect? Which ones are profitable and not profitable? In the credit union industry, sometimes this is not a conversation people want to have, but we really need to understand and try and help build relationships that become a win-win for our organization. More advanced ways of looking at this is we need to understand a much deeper level of relationship profitability. A broad guess at profit is not helpful. And profit tied to the GL that simply looks at institutional profitability ignores what the value of relationships are, and sometimes cause us, even with relationship profit, to think about just how much is that member or customer making us, without thinking forward and understanding what is the lifetime value of that relationship. And why that's important today, somewhere between $200 and $1,000 is the cost of getting a new member or customer. So you have to understand, if you're spending that much on one new prospect acquisition, what's the best chance for lifetime value? That's work that we are working in now with our clients, is to understand how that's emerging. And the way to do that is really to understand, through the use of analytics, a whole lot more about knowing your customers, is profiling those customers and learning more about them. Who's my ideal user audience? Who's the power user that's most engaged today? When we know that, then we can profile that and find lookalikes within our own membership customer base, and we can find them in the communities around us. Let's find the ideal people who actually choose to bank with us and choose a deep relationship. That allows us to now begin to think about more about who those people are, so that rather than simply sending broadcast messaging, we can lean in through the use of behavioral and predictive triggers, and now really begin to understand what is it that they need in their life at one point in time. And then ultimately optimize both content and channel to deliver relevant information, instead of a bunch of cross-selling irrelevant pieces, not timely to people. In diving into our analytics, we can understand the differences between markets geographically, between behaviors of people who, in the case of credit unions, joined the credit union on their own or came through an indirect dealer relationship, understand those and what their relationship is and what those patterns grow as, so that we understand what does that journey really look like, and then to leverage that lifestyle segmentation data into data-driven lifestyle personas that can be tracked, measured, evaluated, and journeys built around them that we can take even down to the level of every employee inside the branch through the use of automation and CRM systems, and be able to start having a conversation about what people really need in life and how we can be more relevant to help them. That is a differentiator that's not just about branch or technology. Now, armed with that, we shift gears in how we apply that data.
Yeah, so armed with our understanding of our ideal members, we take that information and put that into our branch strategy. And so I'm going to show you our overall process here. At Strum, we believe in zero-based branch analysis, and what that means is looking at your markets with a fresh slate. So as if you had built no branch whatsoever, purely on the data that we would gather and have, and then big data that's added on as well. So we start at the macro level at geographic markets, looking at demographics and lifestyles, looking at market share as specific products. What have you captured? What's the opportunity in that particular market for individual products? Looking at building a scoring model. I'll go into a little bit more detail of what a scoring model is, down to the site location analysis. So after all the modeling is done, looking at particular sites and getting real estate insight and on the ground insight of what actually is happening within that market, with building out a recommendation that is 5 to 7 years out. So before we start though, I'd like to do a brief poll for the room. I'm going to go ahead and launch this, and I'll share results in a little bit. All right, we still have some numbers coming in.
And I wonder if it's optimized yet.
I had a few last minute. I'm going to wait just a minute and then I'll stop.
Okay.
Okay, I'm going to go ahead and stop it right now, and share the results. So hopefully everyone can see the results in front of you. So it looks like, and we actually did this poll, a similar poll. Mark, when did we do this poll?
About 3 years
ago. About 3 years ago. Okay. So comparatively, looks like previously we had a 38%, so it's a little bit slightly higher for more than once a year. We had the same for every 2 years. We had 23%, exactly the same. We had 8%, so it's a little higher now, for every 5 years, and then 31%, somewhat similar for do not assess the network. So thanks for sharing. That's very, very interesting. All right. So our process is looking at, I mentioned zero branch, so looking as if you didn't have any branches in a particular market, but we do have branches in certain markets. So looking at what actually is being captured is important on the analytics. So understanding what the growth has been, understanding what the average deposit has been per member, looking at what's the own versus lease. These are all important characteristics that should be weighed in and talked about when you're looking at your full network. Then we look at big data. So we're looking at what's actually in the market. Now we've looked at what we've captured, but we want to see what's actually in the market for our opportunity, and being able to slice and dice that information and find out what's important for each financial institution. When we find out, based off of the numbers that we're looking at and direction of each individual financial institution, we build a custom scoring model. And the scoring model is built with, if we're obviously picking an ideal custom lifestyle segment, we're putting that into our scoring model. Normally a higher weighting, because we want to put an importance in that particular variable. But it's not the only variable that should be driving branch decisions. So we put different variables depending on conversations, depending on where the direction of that particular financial institution is going and what's happening in the market. After everything is weighed, we come back with a shaded map, which shows specifically the areas that we should be looking at. So we have an example map right here where red would show high concentrations of your match score, and blue would represent low concentrations of your scoring model. So after that scoring model is done, we obviously have to take that a little bit further and figure out what's happening on the ground in that particular market. But after this is all built, everyone wants to know, when will I actually make a profit on this particular branch? And this is where it gets tricky if you don't have a full view of your membership and don't have a full understanding of what's in the market and individual profit at the account and member level. If you don't have that information, it's hard to run realistic break-even profitability and have a buy-in from a CFO saying, I believe in all these numbers. We have an open book on this profitability model, and we go back and forth. We would go back and forth to make sure everyone agrees with their variables that are put in. One of the end deliverables is looking at a 5 to 7 year roadmap. So it's looking at specific intersections, timing. What does that branch network look like at the final build? So we can turn around and say, what is our capital that we will be spending, and when will we actually make money on these particular branches? And right now, because of where branches are going to see less transactions, it is very important to understand when you will actually start making money on certain types of branches that are being deployed. So will the branch design change? This is a recent study across design, looked at, really kind of simplified it here, 3 different markets, and saying, yes, the branch will likely change, but it really depends on the market that you're in. All markets are created equal. And so you're looking at densely populated markets where branches need to change because of social distancing, sanitation, making sure that everyone is safe. Middle ground markets, so these are markets that are middle tier markets that aren't quite as big as densely populated markets. We'll see modest changes in social distancing. So you're moving desks, cashless or contactless transactions. How are we dealing with this inside the branch? And then dealing with, is there no change in the market? There's saying, in certain rural areas where COVID really wasn't affected, are we even making any changes? No COVID change. No, there's not much of a COVID instance here as a warrant making major branch design changes. So how will you balance social distancing with relationship building? I think this is a big question. This is a survey that just was recently released in April, Financial Brand, looking at how to fight branch anxiety during COVID. And over 51% felt it was very important to have adequate separation between customers and branch staff in all areas. And adequate separation currently right now is 6 feet. So how do you have a transaction with a customer or member when you have to be six feet away? I've actually had stories of several of our clients that they almost do a dance where they're at the MSR, or they're at the teller counter, and they're putting a paper down and moving back, and the customer is coming up to the counter, and there's a transaction, and then the customer moves back and the teller moves forward. So a little bit of a dance. It's an interesting way to deal with what we're dealing with right now.
So we've designed at Strum Agency over 1,700 branches over the last 25 years. We've learned some interesting things about what it means to enrich experiences. We've learned what consumers prefer in research we've done. We've learned how to bank small businesses and the transition in how small businesses want to use the branch differently than consumers. And some of those keys now are beginning to shift as we look at what will happen as we now have to address things like distancing and contactless engagement in transactions. We're beginning to tweak and think about what advice and guidance will look like when we're in more personal space and addressing people. What we're not losing is the importance of advocacy and the importance of building relationships and driving relationships. And the people that do want to come to branches are really looking for advice, guidance, and ways to improve their financial health. And so I think this is one of those key transitions. This isn't going to be a future with technology that's about cross-selling products. It's going to be a future that's about helping people bank smarter, save smarter, borrow smarter, ensure there's insurance and wise investments wrapped around a comprehensive way of helping people improve their financial health. We're going to see other changes. We're going to see a lot more use of technology to allow appointments and scheduling to be done in advance. Some of the design work we've been doing for a number of years is moving to the integration of more smart ATMs, ITMs, pads, and dialogue towers and stations that allow us now to have a more one-on-one conversation. And we're going to be thinking already about some of the design of those stations, but they were set up for this kind of world. We certainly know we're going to see advances in new kinds of drive-ups. This is a 24/7 access. It's both a billboard and a showcase in the market you serve, and an opportunity to do things in new ways, in ways consumers may prefer to bank, and may be far more less expensive than full service, full branch brick and mortar. And we're going to see innovation. We're going to see not just traditional branches. We're going to see new ideas and a willingness to sometimes take some good calculated risks. One of our clients in North Carolina, Legacy, built a partnership with their large local university in town and bridged this idea that financial and physical wellness really wrap around what makes people truly well. I can't be healthy if you just address what I need from a doctor or exercise if I'm not addressing my financial wellness and finding correlations in those ideas. We're completely going to be rethinking what the inside spaces and the ways we address relationships is going to look like ahead. And one of the keys that we think, no matter what you decide to do with your branches, with your technology, is you're going to need to now focus on analytics-driven experiences and keying in on what that innovation look like. Because we believe that's going to be brand distinction. No one on this call is going to beat Wells Fargo, B of A, or Chase in better online or mobile banking. It will not transform your brand, but deeper relationships where you know your customers phenomenally better will. One of the leads in that clearly is Amazon. And for Jeff Bezos, this isn't about technology at all. It's about leveraging data of what people want, what they do, what their behaviors and issues are. And it comes back to your brand and how you stand apart. And so for Amazon, that means people would rather have very simple experiences and are willing to give up a lot of information and personal data if you will make their lives and decisions simpler and easier. Now, not everyone wants an Echo sitting in their room in their house. That's great. The point is, consumers are willing to share their data if you will make their lives simpler and easier. Amazon, over a year and a half ago, far ahead of its time, began designing brick and mortar that's completely contactless. Amazon Go stores are called just walk out shopping. Literally, you throw things in your bag, and not only do you not have to pay, you just walk out. All of our sensors and technology have allowed that to occur. Analytics are going to be critical to improve your customers and members' lives. There's 4 things we think you need to do now. And that is, if you're not already there, you're going to need to accelerate your data analytics journey much faster. That should focus tremendously on knowing your customer. KYC is critical to understand if you really want to make their journeys simpler, richer, and more valuable, you're going to need data about your members and customers. You're going to need to drive that data because we're swimming in a sea of data there could be no more data than the financial industry already has about your relationships. You're going to need to enhance that data, and you're going to have to drive insights from that data to help define good journey mapping and what engagement truly looks like. What does it mean when someone goes from one service relationship to deeper engagement to loyalty, where their net promoter score rises to the highest level, and you're now driving growth through referrals? It's going to require good marketing automation that's integrated with that data if you hope to move to personalization. And that's not just on a technology level. That's right in front of the branches and your call center employees. We're going to need rich data to create richer onboarding and reboarding experiences. Analytics have never been more important than they are right now. We need to know everything we can to serve our members and customers well. That data has to be integrated somehow and pulled together in usable, accessible places that managers and employees can leverage. Unfortunately, we're way behind. 84% of financial institutions identified that there's either no use or minimal use of the cloud today, or customer member journey mapping. 70% are doing no process reengineering or automation. This is May of 2020, last month. We're going to have to pick up the speed to advance experiences in the leveraging of analytics. Now, Strum has spent 18 years in data analytics. We've used it in our strategies for analyzing markets, for assessing members and customers, for identifying what it means to build and grow relationships. And we finally spent the last 2 years building our own cloud-based fintech data platform, because we know this is the most important information that managers need to manage their organization. That includes managing their branches, managing sales and growth, understanding the relationships, who's opening accounts at the branches, which branches are rising and falling, and managing that on a daily basis and visualizing that data, and not having to walk to the IT department to get in line for 3 weeks to get simple answers to questions about what's going on and how we can express and advance those decisions. Integrated with marketing automation, visualized data, segmentation, and branch intelligence, this business intelligence now allows us to move into developing viable and automated journeys that we now can harness this data and not only manage our branches better, but manage the relationships that we have. And that's key to our future. Our system has been built in the right way. And that is, we think about onboarding a brand new member or customer that opened an account yesterday and not thinking about doing it with email alone or a postcard alone, because this is not where people are living. They are living and experiencing in a variety of channels in an omni-channel world, and we need to be insightful about what we present to them, and we especially need to be individualized and personalized to where they need help. And they are not ever going to need more help than in the next 12 to 24 months. And so whether this is small businesses or consumers, the ability to automate these processes and allow them to leverage and learn from rich behavioral and predictive analytics has never been higher. What the systems of good analytics do is they also allow you on a day-to-day basis to track and learn and see what's happening. Not just vanity metrics. Of course, we want to know what website visits and pages are being viewed. We want to understand actually what actions are they taking. And this has been a challenge and a problem of analytics platforms in the past. The last mile of moving to where we interact with our members and customers, and we know what they're doing, and we can actually identify attribution and conversion. When did they reach that loan application page and actually fill it out and open that account or a related account and quantify that and pinpoint the ROI? So we're not just looking at click-through rates, we're understanding the very journey and relationship people are taking, and we can quantify how that's occurring. Now, what becomes rich about that is we can leverage that information in the data lake using artificial intelligence and machine learning to make sure it's getting smarter every day, every week, and we're learning from that data as we go. That really leads us to the end and a summary of 5 things we think are key in future of branches and relationship building. One is, if you haven't, or if you haven't in some time, you should be analyzing not only your branches for optimization, but the markets around you. And you're going to need lifestyle segmentation about your own members and customers that can then be applied to the people that live around you that are not your customers and members yet, to know who are the ideal prospects you're going to grow with in the future. You're going to need to accelerate your move into analytics and embracing a new balance of channels. Branches absolutely have a role in the future, but they're going to be changing. We are on a path of a rise of expectation for faster, simpler, and rich experiences in the branch, on the phones, and in technology. And you're going to need to ready your teams for that change. And I think the best institutions are now leveraging partners to help them advance digital transformation and analytics much more quickly than the 2 to 3 years it's taking minimum for most people in that journey. We think all those pieces together really help folks protect your brand and your position in the market. It's not an option not to win. We are all going to be challenged ahead. And the question was, how will we emerge? Ben, I'm going to turn it back to you for some questions.
All right. Yeah, we're right at close to our hour, but we'll go ahead and open it up to questions. If you have a question, go ahead and click on the Q&A, type the question in. We'll be more than happy to answer whatever question you might have. Mark, it looks like getting a couple questions in already previously. So I have a question here for us of what's the right number of branches for a financial institution?
Yeah, that is probably one of the biggest questions being asked today. You know, does our asset size drive a certain number of branches? What is the right number? Do we have too many? Do we not have enough? Should we be building, closing, moving? And the answer to that question is yes. And how many is right number completely varies by every institution, the markets you're in, the people you serve, how your branches are performing today, both from a sales and growth position, from a transactional standpoint, because we know transactions at the branch level are dropping, but what's the business that's occurring? What kinds of problems are being solved in relationships or growing in those branches? And we see massive variance in that. And so the question of what's the right number can't be done without an analysis leveraging analytics, both to understand current branch performance, how the market behaves, what big data we can use, understanding which of your members and customers use the branches for what, and what their contribution and engagement and profitability is to the organization. That's the kinds of things that helps us decide how many branches are underperforming and should be closed now, because some of those decisions may be driven just by the economy.
Actually, that's a perfect little segue into the second question is, What is the risk of closing branches and losing customers?
Yeah, so we've certainly had to forecast and identify percentages and numbers, and having studied branches using analytics, using pro formas, break-evens, and profitability analysis, and studying trends nationwide in the US and in Canada for the last 20 plus years, we've really come to understand what it means to close a branch and how to do it well and right. And is there some risk? Certainly there is. Are there ways to do it right? Absolutely. And that should be part of a wider optimization strategy, not simply closing branches for the sake of closing branches. You want to understand what the short, medium, and long-term implications and timing of every one of those are. And with a mix of leases and owned properties, all of those decisions need to be taken into consideration so that you make wise choices and have a broader sense that ultimately it needs to be about growth, relationship building, retention, but you're also going to need to make some financial decisions that are going to be hard decisions ahead.
Thank you. Here's another question. How long does a branch strategy take to build?
That's a great question. Part of that is how good is your data? How much does that need to be cleaned, scrubbed, normalized? That's the process that we do. We build relational databases out of a wide range of data. So we're not just looking at data from the core. We're pulling in information about mortgages and credit cards and investments and disparate data so that we're forming a really clear and robust picture. We're building profitability at a relationship level so that we understand which accounts, products are more or less profitable, apply that to the relationship of individual members and customers, not just households, and then roll that up to identify which of those customers and members are at which branches so that we can apply that profitability into the branch side. And so to do all of those pieces, it's typically a 3 to 4 month process, all in until the point we're making recommendations for the next 5 to 7 years and able to inform the board out of the millions of dollars in brick and mortar, which physical spaces to close, move, shrink, grow, renovate, and ultimately, are there any new locations that should be built? And if we pick new locations, we've run a sophisticated pro forma and break-even analysis based on the reality of what now is going on in the market.
Mark, do you have any differentiation strategies that you'd suggest to get consumers to choose digital channels rather than traditional branches in the post-COVID crisis?
Yeah, it's interesting. You know, this level of advancement is, we're seeing a lot of our clients are seeing between 15 and 30% increases in online banking, mobile adoption. And so there's never been a more right time to lean in. The question again, though, is who is the right member or customer to make those offers to, rather than a blanket, let's email everyone and tell everyone to convert. We really need to understand what people's preferences are and lean in and be attuned to their needs and understand what that looks like. But I don't think there's been a more ripe time from a marketing standpoint to leverage data and lean in and find that this is a natural path for a lot of people. And this isn't just a millennial or a Gen Z question that they're going to use more technology. As Ben pointed out earlier, the adoption levels among boomers and older generations are the highest growth rates we're seeing in some cases. There's a willingness now to use contactless mobile online services, and unclarity about what physical touch in branches looks like. And so it'd take me a long time to actually identify and talk about a strategy, but
Yeah.
this is the time to be building those strategies.
I think I'll take this last one. So it'll be a last question today. And if you have any other questions, feel free to write them in, and we'll catch up with you. I realize we're going several minutes past our hour here. I was asked, are you able to share this presentation? And yes, everyone will receive a recording of this presentation tomorrow. Everyone that signed up will receive a recording of this presentation, so you'll be able to share it off if you'd like. So I want to thank everyone for joining today, and thank Mark for joining me and presenting so we can share some of our insights on what's going on with COVID and branches.
Yeah, what a time to be using this. I call it the slack tide time, where we're unsure of what the future is. What a great time to really lean into our strategies and an understanding and making some tangible advancements and changes right now. Thanks, and we appreciate all of you attending.
Thank you so much.